Hey everyone, welcome back to Corporate Decoder. Today we're diving into the latest report from AIM Investment Funds. And let me tell you, this report is so loaded with jargon, it's like trying to understand a doctor's handwriting. Only this could actually affect your money. But fear not, we're here to untangle it. As before we get started, if you enjoy having complex corporate filings explained in plain English, make sure to subscribe and do not forget to join our discussion on Discord, linked in the description. This filing is a semi-annual report from a group of mutual funds under the umbrella of AIM Investment Funds, now known as Invesco Investment Funds. It's a peek under the hood at how these funds are performing and what they're holding. The focus here is Invesco Balanced Risk Allocation Fund and Invesco Balanced Risk Commodity Strategy Fund, specifically examining their costs, holdings, and overall strategies. Let's talk about costs. How much does it actually cost to invest in these funds? For the Invesco Balanced Risk Allocation Fund, Class A, it's about $65 for every $10,000 you invest over 6 months. That's an annualized 1.32%. Keep in mind the filings show this accounts for fee waivers and expense reimbursements, without which expenses would have been higher. So it's actually more than that. The Invesco Balanced Risk Allocation Fund manages about $953 million. It manages a lot of money, so you really need to pay attention to where that money is allocated. This fund focuses on spreading risk across different asset classes. Equities, which is stocks, and options are their 31% weight, with about half its assets. Pretty standard, they try to balance it out. A large portion is in commodities linked to raw materials with a risk contribution of 42%. That means they want commodities to make up that much of the risk in the fund, but these only make up around 32% of the assets. The Invesco Developing Markets Fund is heavily invested in Taiwan Semiconductor and Tencent. Taiwan makes a massive amount of the computer chips of the world, and a lot of investors are banking on it. Let's move into healthcare. The Invesco Healthcare Fund's largest holding is Eli Lilly, making drugs like Mounjaro and Zepbound, almost 10% of its assets. Then is Boston Scientific, which is a healthcare equipment company. The Invesco Core Bond Fund has a crazy high portfolio turnover rate, coming in at an insane 33%, meaning they turned over their entire portfolio almost 3 times. As of April 30, 2025, the fund has 1,495 holdings. Republic of Poland bonds 422, Extend Turkey bonds 3x Engine, Turkey bonds 3x Engine. These are interesting locations with a lot of financial potential and risk. Also, 8% of its assets are kept in cash and money market. For the Global Allocation Fund, we can see that the top holding is Invesco Russell 1000 Equal Weight Income Advantage ETF, representing about 22.47%, then followed by Invesco International Dynamic Multi-Factor ETF, coming in at 15.21%, and then followed by Invesco International Dynamic Multi-Factor ETF, coming in at 15.21%. Again, with the Taiwan Semiconductor investments. The fund also reports investments in Fomento Economica Mexi, Kano SABD, CV Class B, and HDFC Bankind member, Seith Dakanov S.A.A. Pedia, KV Class B, and HDFC BAXA member, Grupo Mexicos ABD, V Class B, and HDFC Biankemit member. It appears they are putting a lot of emphasis by having security types each less than one of portfolio member. In other words, it's diversified, but in a way that nothing is too heavily weighted. Now let's move to the actual structure of these funds. There's some interesting legalese about being a Delaware statutory trust and about following accounting rules. If you make it though, or that there will be disclosures of what happens if they can't value a fund based on current market info. There are some pretty interesting things that can happen involving experts and various third parties that help the advisor in making good faith determinations. Looking at both the Balanced Risk Allocation Fund and Multi-Strategy Fund that they contain, money market funds plus other assets, less liabilities from the year end, which is a little concerning considering the relative risks involved within the name and strategies. The document then goes on to say that there are security types each less than one a portfolio member, which indicates proper diversification, but not a lot of power in any one specific area. Is this a good thing? It depends based on your perspective. It seems a pretty standard structure that's used by a lot of asset management firms, so maybe that means it's a good thing, but the truth is that it could spell danger. So here's what I am looking at. I'm going to give you some final thoughts and opinion. There really is no real way to determine the actual ethics of any company, as these are high regulated things with compliance, etc., etc. It's a bunch of lip service at the end of the day. I think Invesco appears to be generally well managed given the data from their report. but the risk factors related to high yield investments and emerging markets definitely bear some careful evaluation. It's positioned for some long-term growth, but vulnerable to some major economic downturn. You have to watch these companies carefully to see if the risks make the rewards palatable, and also based on your own personal risk tolerance. That's all for this report. Tell me what you think, and if you appreciated getting the inside scoop from the report, then subscribe to this channel and check out our helpful community on the Discord link below. Thanks for watching, and I will see you all next time.